I'm joined now by my colleague Karen Manczko. Together we'll be discussing both markets and Wespath fund performance. Welcome, Karen. The second quarter was another strong quarter where most U.S. and non-U.S. stocks continued their upward momentum. Some sectors even experienced multiple new all-time highs during the quarter. Let's pull up the charts for trends. What are your thoughts?
The markets still look like they did in the first quarter, where we had strong markets that were led by U.S. markets over international. The same holds true, where just a small number of U.S. stocks, such as NVIDIA, Amazon, Tesla, and Apple, were responsible for the bulk of the market gains. As we can see on the slide, we continue to see growth stocks outperform value stocks. For instance, the Russell 1000 Growth Index was up 21% year to date versus 7% for the Russell 1000 Value. We also continue to see the large technology names, some of which I just noted, driving the markets, with artificial intelligence theme making investors excited for this new technology revolution.
Karen, I agree, and I would add that the AI chip maker you mentioned, NVIDIA, they were up 36% for Q2 and 150% for all of 2024. The growth has continued after the stock was up over 200% in 2023. I personally can't remember a time in my career where one stock was watched so closely. And while these percentages are staggering, only time will tell if NVIDIA can continue to beat expectations or if their growth will finally slow. One other thing to mention, international developed markets continue to lag those of the U.S. The U.S. market has the highest number of technology-type names, roughly 30% in the index. So when technology stocks do well, the U.S. markets tend to outperform international markets. It's worth noting that European elections, we're seeing shifts towards more of a populist state, and the uncertainty around future policy has weighed on these markets. With, for example, France had elections and their markets were down 8% after the June elections.
Thanks for the update about the international markets. I do want to look back and look at the U.S. briefly before we move on. Clients have had a lot of questions about market concentration, where the small number of stocks that are pulling the markets higher. Here's a chart from the JP Morgan that shows the S&P 500 index and breaks out the Magnificent Seven performance on the left in green versus the other 493 stocks in the index in blue. On the top right, you can see that the earnings from the Magnificent Seven for the past 2 years has dwarfed that of the remaining 493 stocks. However, JP Morgan is estimating that growth will eventually even out, which suggests the outperformance and concentration may be nearing its peak. Joe, you wrote a blog back in February about the Magnificent Seven not being a bubble. What are your thoughts now, given that these stocks continue to outperform the market?
Yeah, thanks, Karen. In that blog, we compared and contrasted the performance of the dot-com era from the late 90s, early 2000s to the Magnificent Seven of today. So that the key is that much of the dot-com era was mania around the future of the internet. And that did prove to be an enormous technology, just like we had thought. But the difference is that many of the companies that rallied and crashed because they were new businesses, but they were also really bad businesses. Think like Pets.com. Mm-hmm. The Mag 7 are large, well-established companies with big moats, high margins, and these are the ones that are poised to take advantage of artificial intelligence. Then the question is, why this magnitude of outperformance? And I wrote a blog about this in Q2, which we published on July 3rd. And there's a couple things to highlight. And the first is earnings. You already noted this, but the earnings that these mega caps have continued to show are just superior to those of the rest of the market. Another thing is buybacks. Goldman Sachs estimates that buybacks remain really high, roughly $5 billion per day. And that's about $1 trillion per year. And then Fidelity wrote that since 2009, the issuance of shares totals $2.7 trillion, with the reduction in shares at $21.3 trillion, meaning that $21.3 trillion of shares have been bought back, which is 10 times the amount that has been issued. So these levels of concentration, historically, though, don't last forever. But the question is, what would trigger the rest of the market to catch up? It's very likely that it would be earnings of these mega cap stocks if they were to roll over, along with the earnings growth from the other 493 catching up. So earnings is going to be key for Q2 in the second half of the year. But let's switch gears a bit. Now that we've highlighted the quarter, let's look at Wespath equity funds. And I'll note that in the Wall Street Journal wrote last week that 18% of active funds have beat the index this year, and last year was only 19%. The only way to beat the market was to overweight these 7 names, the Mag 7, which is not how we are positioned in our funds.
Correct. Our U.S. equity fund owns these mega cap names, but has a lower weighting to them versus the index. With this said, in this environment where these names are driving the market with their strong performance, we underperformed.
And what about the international fund?
As we showed earlier, international markets did not fare as strongly as the U.S., but they were in positive territory with emerging markets leading the way. But our international equity fund did not fare as well as the market and underperformed its benchmark for the quarter and year to date due to stock selection by our active managers. But before we move on to fixed income, I do want to highlight that our current Chief Investment Officer, Dave Zellner, and the incoming Chief Investment Officer, Jahara Farahadieh, will be talking later on this webinar about Wespath's equity performance. They're going to dive a bit into the deeper trends of the mega cap underweight and the outperformance of U.S. stocks relative to international stocks. So I think viewers will want to stick around for that.
So the fixed income markets have not been quite as headline-making as equities on the quarter, especially compared to the volatility that we saw in the market and rates in 2022 and 2023. Of course, inflation has come down from 9% to 3%. What is your update for bonds this quarter?
A good point to start talking about the fixed income market is by looking at the yield curve. And we borrowed this chart from JP Morgan, which looks at the curve at 3 other points in its cycle. July last year, when the inversion in the curve peaked. October 2023, when the 10-year was at its highest point. And August 2020, when the 10-year was at its lowest point. A good measure that helps drive the yield curve is obviously the inflation numbers. And you mentioned they're lower. Joe, tell us a little bit more about that, inflation.
Yeah, so you can see in this chart that inflation is leveling off and is closer to 3%, though that's still above the Fed's target. So you can see that the majority of the inflation is driven by housing, which is a little stickier than other things like, say, energy. So meaning it's going to take some time to reach the Fed's target of 2%.
I did see recently that the Fed updated its dot plot, which expects to deliver just 1 rate cut this year, which is down from the earlier expectations of 3 cuts.
Yeah, and after the inflation numbers from yesterday, I think the September rate cut expectations are now about 80%. So for 25 basis point cut. So closing out this section, I briefly want to look at the fixed income fund performance. You can see that the fixed income fund outperformed its benchmark for the quarter and year to date. The primary driver for outperformance has been the issue selection by our Core Plus manager and overweight to high yield bonds. The inflation protection fund did underperform for the quarter and year to date. The primary driver was allocation and issue selection to emerging market inflation-linked bonds and these currencies, especially the Brazilian real, which weakened relative to the dollar.
Thanks for the fixed income update, Joe, and thank you to our viewers for tuning in. For more detailed fund attribution information, please check out the latest monthly investment report on our website and tune in to Dave and Jahara's webinar discussion. As always, please feel free to reach out if you have any questions.